Let us understand the concept of DuPont analysis today. Okay, so DuPont is the person who prepared this analysis. So you know that the most important formula for analyzing any company, you go from the angle of investors, from the point of view of shareholders, is return on equity, right? So formula for return on equity is PAT, profit after tax, divided by your equity, that is equity share capital plus free reserves. All right. So uh, with the help of DuPont analysis, we divide this formula into three parts. First is your net profit margin, right, which is equal to PAT divided by sales. After that, we are concerned about asset turnover, right? Asset turnover, which is equal to sales divided by assets. And third and last part of this DuPont analysis is your leverage, or yeah, you can call it as leverage, right? So leverage, which is equal to your assets divided by equity, right? That means how much of your assets are made up of equity and the balance is made up of loan, right? So DuPont analysis is basically multiplication of all these parameters, that is PAT by sales multiplied by sales by assets multiplied by assets divided by equity. So sales gone, assets gone. So remaining is PAT divided by equity. So why this DuPont analysis is very important? Because it suggests that for your ROE to be good, like north of 20%, for example, which is considered as a good ROE, return on equity, either your margin needs to be better, which is paid by sales, or your asset turnover needs to be good, or you should have leverage. So you can see that in case of manufacturing companies, FMCG means fast moving consumer goods, this margin is generally better. Pharma companies, right? But their asset turnover and leverage may not be there. In case of a business like D-Mart, there is not much margin, neither it is leverage, but it has a good amount of asset turnover. That means on the basis of 100 rupees of assets, it generates a lot of sales. Okay. And in case of banking finance, those businesses have very less PAT margin, but they have very good leverage. That is, their business is to borrow from somewhere and lend it to somewhere, right? So that's how you analyze a company from the angle of investor. Either your profit margin is good, either you have good asset turnover, or either you are leveraged. All right. So that was our DuPont analysis. Let us take one example. XYZ Company Limited has revenue of 29,261, net income, that is profit after tax, 4212, assets of 27,987, and equity of 13,572. So in this case, your PAT margin will be 29, sorry, 4212 divided by 29,261, which is equal to divided by 29,261, which is 14.39%. So we'll write it here, 14.39%. All right. Now your asset turnover, that is sales divided by asset for this company, is equal to 20 29,261 divided by 27,987. Right, I am gonna rub this off. Okay, so this comes to 29,261 divided by 27,987, that is 1.04. Right, so we'll write it here 1.046. Right, and now last part, your leverage, which is equity 29,261 divided by 27,987, that is 1.04. Right, so we'll write it here 1.046. Right, and now last part, your leverage, which is equity which is equal to asset is 27,987 divided by equity is 13,572. All right, so this is 2.06. Right, so your ROE is equal to this multiplied by this multiplied by this, so 14.39% multiplied by 1.046 multiplied by 2.06, which is equal to this multiplied by this multiplied by this 200 31.03%, which is a great ROE. Why? Because the business is a little bit leveraged, that is equity is half of the asset, then you have good profit after tax margin, that is why they have return on equity of 31%. So that is how we analyze the company from the point of view of DuPont analysis. I hope you understood the concept. Thank you.